Hi, I'm Ross from Crimsmith 150 Group Property Accountants, and just speaking today about some different structuring opportunities. How much difference can it make? What's the difference sort of in tax that we can look at? And yeah, obviously tax is only one part of what we're looking at with structure, but yeah, it's a good idea just to run through the different ideas. If you've got some existing properties, and you're looking at things like the new interest rules coming through, you're looking at paying a whole lot more tax. Potentially we can rearrange things. It does depend on the situation, but yeah, some potential there. So this is sort of an example just to give you a couple of different things to look at. And I think at the end, yeah, you'll see there's a very large difference in tax. So we've got Bob and Sue. Bob earns 25,000 of income a year. Jill earns 185. They've got 5 children, an 18-year-old with no income, a 16-year-old with no income, and 3 under 10. They've also got rental properties generating 80,000 per year. So obviously that's a large amount of profit, and a lot of people going, oh yeah, I'm not earning that much. Well, with these new interest deduction rules and you losing interest, you might actually find that your profit is jumping up a little bit if you're not able to claim that interest deduction. And it's going to obviously slowly increase over the next 4 years. But potentially your profit is going to jump up if you've got a number of rentals in the old existing and not with social housing. So who should own the rental? There is no perfect answer. There's not one situation. I'm not saying to jump and do these structures tomorrow. Everyone is different. But yeah, obviously there's a good opportunity at the start that we can set things up in the best possible way. If you're not set up in the best possible way and you've already got rentals, it's a whole lot harder. We have to look at what is the commercial reason for doing the restructure. Can we do it without, yeah, triggering bright line rules, triggering a bright line sale, triggering a bright line reset, or getting caught by other tax provisions? So it is so much easier to do at the start, but if you've got existing rentals, there is some opportunities and there is some, yeah, tricks that can save thousands in tax. So the first boring one is Bob. Bob owns the rental properties himself. So he's earning 25,000. He gets up to 48,000 at 17.5. So that's another 23,000 or about 4,000 of tax. From 48 to 70, he gets taxed at 30%. And then yeah, the last 35,000 gets taxed at 33% because he's over the 70,000 threshold. So total tax, we're looking at 22,000 for that. Sue owns the property. She's already earning 185,000, so she's in the 39% tax bracket. I don't know why we'd want to set it up with Sue owning the property, but if it was set up, yeah, all the 80,000 is at 39% tax bracket, so she's going to get 31,200 of tax, and obviously that is not structured well. If you're in a situation like this and you're Sue, but you own all the rental properties as well, and you are going to get taxed at 39%, it's worth having a talk to me and having a look. How can we restructure this? What's our commercial reason for doing it? And I've definitely got a few in my mind straight away. And looking at, yeah, what's the cost? Can we change this around? Is it worthwhile? Can we do it a better, smarter way? And chances are we could. If they own it together, Bob and Sue own the properties together. Obviously, yeah, normal partnership will be 50-50 unless they have an actual partnership agreement for a different percentage, but just be careful what the reasoning is around that. Sue, for her 40,000 at 39%, 15,600 tax. Bob again gets some at 17.5, some at 30%. Overall tax 24,725. Then we start to get some more interesting structures. So the personal names, the partnerships, pretty dull and boring. Not things that we often use, but you might be stuck with them. It might not be worth changing away, or it might be impossible to change away. Then we look at a normal company. I generally hate normal companies. Big problems getting out capital gains. It's a real hassle trying to get that capital gain out. So for example, you own 3 properties worth $1 million. 10, 11, 12, 15 years later, they double in value. They go from $1 million to $2 million. And you decide to sell one. You make $1 million capital gain and you go, right, I'm going to pay off the personal home, or I'm going to buy a batch, or I'm just going to go to the casino and I'm going to blow the $1 million. Whatever you choose to do it. The problem is that's the company's capital gain. It is not yours. So if you take that money out, you still owe the company. You're most likely going to have an overdrawn current account. The company is going to have to charge you interest. That is going to be taxable income, creating more tax. That is not good. A normal company can't distribute the capital gains without paying tax. You can't liquidate the company because it's got 2 other properties in it. It's impossible or very, very awkward to get that capital gain out of the normal company, and it's a big issue. So normally I don't like normal companies, and to be honest, they are really hard to fix. That is not easy. So if you've got the opportunity going forward, be very, very careful. And it's only in very select circumstances I'd use a normal company. You tax at 28%. Everyone's exciting. Rather than paying those higher tax rates, you're only 22,400 of tax. It's sounding good, but what is the problem? And the problem is sooner or later, you want to get that cash out. You want to pay off your personal home. You want to buy the batch. You want to spend that cash flow. At that point, you have to declare dividends, pay an extra 5% in tax. That's an extra 4,000 in tax. You're up to 26,400 already. My slides is coming up a little bit wrong. A structure we use quite often is a trust or an LTC owned by a trust. A trust is 33% tax. Yeah, a little bit boring at that stage. We're thinking, why do we bother? But there's a whole lot more options. So say we allocate the 18-year-old $14,000. He or she gets taxed at 10.5%. That's only $1,470 tax. So a lot lower tax. And generally, if we're allocating 14, we'd want the trust to be spending 14,000 on the beneficiary. So it might be paying for musical lessons, instruments, sporting trips, overseas trips, a car, lots of different things that you might be spending on your child over and above normal parental duties. So the trust could pay for them and it could offset the 14,000 being allocated. The 16-year-old, the same. And if this under 16, we can allocate them $1,000 a year, and that's generally tax-free. So we can allocate 14, maybe 14, as long as we're spending it on the children or thinking about that long term, that we're not getting too big a liability to the children. Allocating $1,000 to the younger children, and we've got 49,000 left. We can still allocate some to Bob, use up those 17.5% tax bracket and use up the 33%. Then we've got 4,000 left, could stay in the trust, which is probably what I would do with it, or it could get allocated to Bob as well. The tax on that, 14,885, 15,000 of tax. So if we look at all those different things, we've got Bob, 22,000 of tax, Sue, 31, not sure why we would do that one. The partnership or them together, 24, 25,000 of tax. A normal company starts at 22, pay 4,000 extra. And then, yeah, those dividends are going to have to be returned by the ultimate shareholders. Say that's Bob and Sue, so then it will ultimately go to them at the 24,725, but you'd actually pay the 26 first, then get some back. Or we can get, potentially in this case, with so many children and opportunities, yeah, the LTC owned by the trust or the trust could give us a whole lot more opportunities and, yeah, quite a savings in tax. So the big thing with this is, yeah, we're about 16,000 difference in tax. So I'm not telling you to rush out and set up a trust or to set up an LTC owned by a trust, but it's just starting to think, what are your options? Is there some clever things you can do there? Do you already have the LTC and already have the trust? In which case, are you just utilizing it correctly? So often with things like this, yeah, it's worth having a proper meeting with me, worth going through your opportunities, looking at the cost, looking at the benefit, and yeah, just seeing where we can end up. So hopefully you've enjoyed that. Hopefully you watched my video yesterday as well, which just had some great information about the current sort of interest rates in the market and what that's doing for cash flow, comparison existing, a new with lower interest rates. So yeah, hopefully you've enjoyed. Thanks a lot.